Welcome, everyone, to Real Estate 360 Live. I am your host, Ryan Sloper. For those of you not familiar with the show, my guest and I will cover every angle of real estate under the sun, from interest rates to the economy to what's happening in Washington. Anything that affects our local real estate markets will be covered here. If you got credit issues and you're trying to get them straightened out so you can buy your first home, you can call me. If you're looking to refinance the lowest rates in U.S. histories, you can call me. If you're considering short selling your home versus letting it go to foreclosure, or you're just kind of going back and forth and debating, what makes the most sense for you and your family, I'd be glad to be the sounding board and let you know what your options are there. Obviously, there, one way or the other can mean the difference between you buying again in 2 years or 5 to 7 years. You've got questions and I've got the answers. Make sure you tune in and join us every Monday at WNEW 1580 AM from 2 to 3 p.m. in the afternoon. And like I said, if you ever have any questions or concerns, please call the off-air phone number. It's 877-245-2030. That's 877-245-2030, where you can visit us via the web at realestate360live.com. That's realestate360live.com. Remember, if it's real estate, it's covered here. Got a good show lined up for you guys today. Joining me on our panel to discuss the many issues from last week as well as what's on deck this week is Louis Cammarosano, who is the general manager of HomeGain. Louis is often cited in the media as an industry expert in the Wall Street Journal, Forbes, CNN Money, Fox Business, Smart Money, MSN, and numerous others. Like I said, we're going to discuss with you about what happened in the markets last week as well as what's going on this week that can affect you and your real estate decisions, whether you're looking to buy or sell or refinance your home. There's everything that goes on in the market takes some sort of position on interest rates and whether, obviously interest rates have been low for an extended period of time, but they continue to move lower. And Louis and I are going to discuss that today. Louis, how you doing today?
I'm okay, Ryan. How are you doing?
I'm doing pretty well, sir. Trying to get back into the swing of things here on this Monday. So obviously, we had a lot of the terrible events that took place out in Colorado at the end of last week. Now we're moving forward into this week. To start the day, it's quite interesting because the 10-year note, I believe, hit down to its lowest in history. Something like 1.395% was the yield on the 10-year note. And what that really did this morning was the stock market was out of, I want to say, about 1% or down 200 some points on the Dow. Much of the situation from that stems from what's going on over in Spain. And the Spanish bailout fears that sparked this sell-off, which essentially what's going on is that everybody's fearing now that the initial estimate for what they were going to bail Spain out is not going to be enough, and that they're going to need some sort of full bailout, which has at this point now pushed the 10-year Spanish bond up to a record high of around 7.565%, which was late Friday at 7.26, and that the Spanish leaders have said this is not a sustainable level at 7%, and I imagine it couldn't be. And so since all the jittery investors are basically saying, well, what are they going to do? It's flushing all the money back into U.S. government bonds, I believe, in the safe haven of some German bonds as well.
Where you get 1% or no percent if you invest in U.S. or German bonds.
Yeah, so I was right. It's 1.395% is where the U.S. touched down at, and the German bond is at a record low of 1.127%. I mean, it's amazing, isn't it?
Well, sure, because then the inflation rate is higher than that. Even the official inflation rate is higher than that. And the issue with the United States bonds is they're perceived safe, and I just don't understand it. But what it does highlight for our real estate investors are that the U.S. rates are artificially low because of the perceived safety of U.S. treasuries, and investors seem to be more comfortable with a sovereign that's able to print up money to pay off the interest and the principal than with a sovereign who just doesn't have the money and has to rely on a bailout. So don't look a gift horse in the mouth. Interest rates are low. They're artificially low, and it may make sense to take out that 30-year mortgage if all other facts and circumstances make sense to take that mortgage out, because you're getting a low 30-year fixed-rate mortgage at rates that are artificially low, and you'll lock them in for 30 years.
Yeah, what's interesting to me, Louis, is, all these people that are out here and investing, and they're just like, I guess they feel like there's not much to invest in, so they're willing to put it into basically debt or, basically treasuries that are just paying these ridiculously low yields, and there's a great opportunity on the other side for investors to physically buy and hold, secured real estate at this point, at, record lows. So to me, there is a lot of opportunity out there, and it's almost like, kind of with the JP Morgan, they're always just looking to make as much money as possible in the markets. And, there's just not that many places that you can put your money right now that's secured. And like I said, my personal opinion is that in certain areas, especially in the D.C. metro area where rent price increases have been pretty dramatic over the last 6 months to a year, I think that they're likely to continue. Louis and I have talked at length about where we think that, rental prices are going to go in the future and the inevitable inflation that's headed our way. It's just a matter of time. So if you're in the market now and you're in a position to be able to, whether you're going to buy a house for yourself to live in, or whether you're looking at buying real estate as a long-term investment, it's a great opportunity. To see these sub 4% interest rates continue, and every week they continue to go lower, and it is artificial, guys. Like we said, this is not something that the government is just doing out of the goodness of their heart to keep these things low. They're keeping them low to help manage this debt level that we have. That is, it's not sustainable if the yields push back up into the 5, 6, 7% range.
Spain is telling us that right now they cannot afford to pay 7.5% interest. The United States is not able to pay a greater percentage on what they owe because we owe trillions of dollars more than Spain owes. Right.
It's almost, we're comparing apples to oranges. As far as the debt level is concerned, as far as what we're carrying versus what Spain's carrying, but we're headed down the same path. We're in a much worse situation long term than they are. And it's only, I don't know what it's going to take for actually Wall Street and investors to actually see this, but it's more or less that it's just like everybody's just on board with what the Fed's doing, and they feel like the Fed has the ultimate ability to continue to manipulate as long as possible until the ship can turn around. Well, unfortunately, I feel at some point that this ship is going to crash, and I don't know when that's going to be. So
I guess it's because it's the biggest ship, and there's no other ships to be on other than, as we mentioned, commodities, gold, silver, and real estate. The problem with those markets are that's not where large amounts of money go because those markets are thinly traded. Pension funds don't really invest in commodities, gold and silver. 401k plans, IRAs, and the average person really does not invest in those items. And those probably are the safer assets, but people are going into U.S. Treasuries. Even municipal bonds, people are driving those up, even though there's the threat of bankruptcy surrounding many of them.
Yeah, and that's the last place I'd want to be. We're seeing in California and many different states. These and on the local levels, they're having. They're saying that they have to make these cuts across the board, but yet they have so many different wasteful spending habits out there that they it's just really ridiculous. And that trend is probably going to continue on into the near for an extended period of time.
And the only way, Ryan, that they can raise revenue is they have to put more cops on the street to give out more parking tickets, speeding tickets. They have to raise, or they can issue more bonds if somebody's willing to. If the voters are willing to vote for a new bond issuance, kind of to pay back the old bonds that they have out, or they have to raise property taxes. So they don't really have. It's not like a company can kind of work their way out of their debt issues by raising revenue or growing their revenues. Municipalities can only take from their citizens, and the problem with the municipalities, you can, as we talked about last week, you can move from one municipality to another or from one state to another to avoid having to pay the increased tax burden.
Yeah, and especially in a very stagnant economy nationally speaking, if you really try to push the citizens, they're going to move. They don't have a choice. So these problems are not going to be solved. And in the end of the day, the only thing that I can see is for these debts to really be either somewhat cut in half, or for the people that own these bonds, they're going to be shorted at some point. We can look over in Europe and see what's going on there. And the only way that that's not going to happen is if the Fed continues to step in and lend out more money, devaluing the dollar further.
But how much longer can they do that? And you should look at Spain and say, that's what the market pays, that's what a sovereign needs to pay if its lenders are worried that they won't pay them back.
Right.
It's more like 7% now. In the United States, they take comfort in that they will get paid back because they can print the difference. But what that does is it debases the value of the dollars you get back. So instead of it being a direct default, it's an indirect default because you don't receive your money back, and you don't even receive the 1% interest because it's less than inflation. So and the fact that they have to print up the money to pay you creates even more inflation. And all this doesn't really help the economy, Ryan, because what it does is it punishes the savers, and it favors the people who borrow. And borrowers in general, if they're borrowing to buy consumer goods, aren't helping the economy. They're just spending money that they don't have and going further into debt.
Yeah,
and
or
the economy's got to be built on savings, and there is no incentive to save because there's no interest being paid because of the low interest rate environment.
And you bring up another good point too, because there's not with the lending guidelines being so restrictive at this point. The people that are the amount of people that are able to take advantage of these low interest rates are the rich. They're the people that actually do have enough capital and are actually showing hundreds of thousands of dollars on their tax returns, if not more, that are able to continue to buy up more real estate by borrowing that money. You know what I mean?
Right. So if you think about what you're saying, Ryan, is that the low interest rate environment doesn't help the overall economy. It helps the banks, it helps the government, and it helps the rich.
Absolutely. And I think at the end of the day, keeping the interest rates low is basically a consumer sentiment thing. I mean, they want to going into these elections, Obama and Mitt Romney Mitt Romney won't have a leg to stand on there because Obama's going to argue, hey, I've kept mortgage interest rates low. It looks like the housing market's starting to turn. But at the end of the day, it's not helping our overall economy.
Right, but if you print up more money, the idea there is to ward off deflation. But, lower prices might be welcomed by people who aren't doing very well or aren't receiving much money on their CDs or interest payments from their savings. So, they've convinced us that somehow inflation is a good thing, when actually inflation destroys savings and destroys an economy, whereas deflation, they're worried about deflation because they're worried that prices will go so low, people won't buy anything. And that's kind of a farce because people bought iPhones when they were much more expensive. The price just keeps going down and people buy more.
Right.
When prices go up, the only way you can afford it, for example, in housing a few years back and in education, is by taking out a loan. And that just drives the price up. That's not the best way to go. I'd rather have deflation any day than inflation.
Yeah,
especially inflation that's created by the central bank by printing up the money to create that inflation, just to keep interest rates low. Right,
and I mean, they've already started talking as if, we're headed in a situation where the Fed's going to ease again. And there's been a lot of speculation as to, okay, well, what are they going to do? Now, a lot of analysts have said that they think that the Ed might continue to purchase the mortgage-backed securities to kind of narrow the spread between the rate on like the 10-year note versus what the 30-year mortgage rate is. So now, is that going to help our overall situation? Is that going to really benefit us? I don't think so, because the different people that aren't going to take advantage of 3.5 interest rates, what's going to make them take advantage of it at 3.25? Because the lending guidelines are not going to change. If anything, it's becoming more and more difficult for people to obtain home loans.
Right. As you mentioned last week, the disincentive for the banks to lend out at even lower rates, especially if they're locking in a 30-year mortgage.
Yeah, I mean, I just saw the other day that FHA streamlines, where they used to allow you, is just as long as you've made your mortgage payments in the last 12 months, if you had over a 640 credit score, that you could, without having to do an appraisal, without having to go through all those things, as long as you just made your payment in the last 12 months and you have over a 640 credit score, that you could do an FHA streamline, which just basically reduces your interest rate. Very easy loan to get done. Well, now they've raised those standards up to a 680 credit score. And it's almost like they don't want to help everybody, right?
The low rates are illusory. If you can't get them, it doesn't matter how low they go.
Exactly. So what they do is the lower they come, the more guidelines they change to prevent people from being able to take advantage of them. I mean, it's a sad state of affairs, because at the end of the day, the people that are benefiting, and I'm happy for these people, don't get me wrong, but are the first-time home buyers, because they're the only ones that are able to take advantage and enter into the market and take advantage of them, because everybody else is upside down. We're coming up on a break. When we come back, we'll continue to talk Spanish bailout fears as well as the job market. Stay right there.